In 2026, a shift is appearing in financially literate Indian households. Many who prioritized aggressive investment are now beginning to save more cash. For years, the consensus was that every rupee should be put to work. To keep wealth in cash was to watch it slowly erode against inflation. These investors haven't stopped investing because of a sudden loss of nerve. They are responding to a change in the economic landscape. The strategy of keeping assets fully invested relied on a degree of stability that no longer matches our current reality. By building cash reserves, these households are preparing for an economy that no longer follows the old rules. The assumption that tomorrow will look roughly like today is starting to crack. Artificial intelligence is replacing tasks that once required the output of entire teams, while companies are becoming more cautious about hiring. And global conflicts are disrupting the trade routes that keep markets moving. In this unpredictable environment, a single headline disrupts entire industries or swings market values overnight. When the future becomes harder to predict, a rigid financial plan becomes a liability. Flexibility becomes a valuable asset in its own right. The typical successful Indian portfolio is often built on illiquid foundations. Wealth is tied up in real estate, physical gold, and mutual funds with long lock-in periods. On paper, this structure represents security. But during a sudden emergency, these assets offer zero usability. Property and jewelry can't be converted into usable money fast enough to absorb sudden economic shocks. Following traditional financial metrics can leave a family wealthy in theory, but vulnerable in practice, if they ignore their immediate need for liquidity. Cash is often judged solely by its ability to generate a direct return, but that completely misses its primary function. In behavioral economics, cash provides option value. It is the price paid to maintain the ability to make choices when circumstances change. Consider two professionals losing their jobs simultaneously. The one without liquid savings makes immediate decisions, accepting the first job offer just to cover basic expenses. The professional with cash reserves has a runway, with the luxury of time to wait for the right opportunity. Cash generates zero yield, but it buys the time required to make better decisions during a personal crisis. The world's most successful investors rarely keep all of their capital deployed. They maintain significant cash reserves not out of fear, but to ensure they can act when others are forced to panic. When markets fall and assets become significantly cheaper, people with cash can act. Those without it can only stand and watch. Liquid reserves form the dividing line between those who can capitalize on a crisis and those permanently sidelined by it. Dosing a cash reserve does not mean liquidating a stock portfolio or hiding money under a mattress. It is the deliberate creation of an accessible emergency fund. This creates financial breathing room, a buffer designed to absorb the shocks of an unpredictable economy. This accumulation of cash acts as a tool for adaptation in a global environment where the future is harder to forecast. This shift represents a move past the cultural preference for illiquid physical assets toward a more flexible form of financial security. Surviving an unpredictable future is less about chasing the highest possible return and more about ensuring you have the room to adapt. Because when the future becomes uncertain, cash stops being a drag on wealth and starts becoming a source of freedom.